I'll give you $500,000 to leave. Okay? He's like, yeah, that sounds great.
I'm retiring.
I bought that property for $3.1 million. It was valued at $4 million the day you signed.
$1 million in uplift without
a tenant.
You haven't put $1 down, and you've increased valuation from 3 to 6. So you've pulled out on paper $3 million. So capital growth does exist.
Once again, no intro today. We've got someone very special for the second time running.
Well, the audience requested it. The listeners loved it. So we welcome back Cal Doggett.
Thank you for having me in. I'm
Welcome, Cal. So last episode when we had you in, we were talking about, I think, why property was the key focus there. But I thought today what would be good with your experience and your background is to actually hone in on the commercial side. I think a lot of our listeners, we get questions and feedback around commercial. We've not done a podcast to date on commercial, so it'd be good to speak to the number one commercial guy in the country and get his opinion on a few different things.
Flattering, very flattering.
So similar to the first podcast we did with you, Cal, we opened it up saying why property, why commercial? Why is that? Why should you choose that over any other?
What a question. Look, firstly, thanks so much for having me, guys. I truly do enjoy this. This is fantastic. Why commercial? I can speak to all the benefits. I think just before you speak to benefits, it's like the benefits are only as good as their comparison to other investments. So, money in a bank, great, because it's going to give you a return, but can you touch it, feel it, improve its value? You look at residential property, okay, like it can house me and I can live in it, but am I willing to sell it one day if I'm living in it? Is that going to impact my lifestyle too much? So you start looking at other, shares, equities, like I can transfer shares and transact shares like that. So very, very liquid. So I mention those because some of those touch on things that commercial property doesn't do, which is why I really like it. So for instance, commercial property is quite illiquid in nature. To try and sell a commercial property, you could be, 3 to 6 months would be lightning. That would be quick. So there's usually a due diligence period, then there's a finance period, then there's, and due diligence on commercial could be anywhere from 30 to 180 days, right? Then there's
it's not just period. The property, right? It's typically the business, the cash flow,
totally.
All the, when you say due diligence, you do due diligence on a house, you get a building inspection, You get someone to check your contract to sale.
Yeah. Oh, no, there's far more. Because of the fact that it's inherently rented to someone, they have a legal right to occupancy of your building, incredibly, or can be a lot more complicated than the residential purchase, right? And because of that, it can be quite illiquid in nature, which, for instance, during COVID, right, there was a patch there in COVID in Australia where commercial property didn't move at all. And yet, tenants were like not paying the rent and things were closing down and like you could only get a haircut, like, everything else was, but there was literally like a 6-month patch where commercial property did not move at all. Valuers were like, we're valuing that the same today as it was yesterday. You're like, wow, that's so interesting.
Even though people are not paying their rents.
Exactly. Because it takes time for that to the market to move like that.
But the share market could drop 15% overnight.
Exactly.
Because it's so liquid, people take their money out.
100%. Share market, boom, like got smashed, right? So I start with that because it's its comparative nature to other investment vehicles. The fact that you got a tenant paying your rent is amazing, only so long as that tenant can afford the rent. And then you start thinking about other things. Well, like, am I getting the right amount of rent on commercial property? So we like it as an investment vehicle for us because we can generate robust returns from an ASX listed company in some cases. And I say that because, again, if I were to go buy Woolworths shares or Wesfarmers shares, what's my dividend, right? Like sub 6%, I'd be very happy getting a 6%. But I can have Woolworths or Wesfarmers paying my rent at 6% in commercial property. So already I'm getting an arbitrage to the share market, right? And then you think, well, underneath those four walls is some land. And you go, okay, well, land's finite in nature, so there's an inherent value to the actual land itself. So that's a really good example, like why we kind of started out in the commercial property game. You can add value with your own hands. You can manage tenants and rents. You can manage expiry dates. You can redevelop. You can create something that humans will interact with differently tomorrow than today. So I think by its very nature and the fact that it's malleable, it means that you can generate pretty fantastic returns there, but you've got to know what you're doing. Whereas your choices on the stock market are sell or buy more. I mean, that's it, right? That's all you got. So we loved the fact that there were a couple of different levers you could pull to create value. You just need to understand the complexities in order to do so.
And with commercial, I think it's understated the capital growth play. I think when people, refer to commercial property, historically, more recently, we've seen a bit of a boom, and we were talking that on the previous episode, how you were able to enter and exit. But I think commercial sits in a cash flow conversation, which it's not true, right? So talk us through that, because I think, like you said, that perfect example there, you have Woolworths paying your rent. Yeah. So essentially there's no outgoings. They're paying you to hold that property. Yeah. But that rent is sitting on a piece of dirt, and that piece of dirt's going up in value.
That's it.
So talk us through that myth of capital growth in commercial, broadly speaking, and then how it's sort of tracked over the longer term.
Yeah, that's an amazing question. So look, commercial property, as you say, you can enjoy an annual return from it, but people do forget the whole capital nature of it. The thing with the capital improvements, or I suppose the capital growth that you can generate in commercial, is that you have to pick your time, because if there's a lease in place, the fact that there's a lease can actually prohibit you from creating more upside. So only when that lease comes up for expiry do you then, as an owner, have access to the land again, or to the building again,
to add value,
to try and add value. So having said that, a vacant building is worth less than an occupied building in most cases. Okay, in most cases, there's some nuance there. But those are ways of. I mean, we've acquired vacant buildings before, and you go, well, if it's human behaviour, would you rather pay more for a vacant asset or a leased asset? You're like, well, having money would be great, so leased would be better. So you can buy something vacant, and you can lease it up and generate enormous
uplift.
Capital growth. Like, I mean, some of the greatest deals, the greatest returns we've done have been in the shortest amount of time, not because we're some warrior or hero, but just because from vacant to leased is a massive movement in value. Because
talk us through an example. People like examples. If you've got a scenario where that's played out.
Yeah. Okay. I got an amazing example. So I bought an asset in Joondalup, and there was a tenant in place, and the tenant was paying about.
So what type of property? Just give us context.
Retail.
And this is Perth for those East Coasters watching.
Yeah. Joondalup.
Joondalup. So retail shed.
Essentially, it was a retail showroom, what we would call, and the lease was struck during COVID, so it was a peppercorn rent. They were paying like $110 a square meter, gross. Okay, in Joondalup, and now your eyes are doing that because in Joondalup, it's like the second best large format retail precinct in the country, right? Like, it's really, really well sought after. So we looked at that and we were like, that's really interesting. They're paying such a low rent.
What's market rent?
Market rent might be $230 to $240, so literally double.
Wow.
But because they were paying this rent and they had a 5-year lease in place, and that lease had an option for another 5 years, and then another 5 years, and then another 5 years, without any escalation, right?
So this guy would have been paying the same under market lease in 20 years' time.
He had a 2% escalation, that's it, but no market review. So usually at the end of a lease term, you would go and see what the market is paying, and then the rent would adjust to what the market's paying. In which case, we would have been licking our lips. Market rent would have gone, bang, 230.
Doubled.
Right? But it didn't. It had 5 plus 5 plus 5 plus 5, and this guy's paying next to nothing, okay? So we went to the tenant, and I said, I'll give you $500,000 to leave.
How's the balls on that?
He was like, what? Hold on, let me get this straight. You're gonna give me money, and I'm gonna go. And I was like, yep.
And what context? What was he paying for the lease for the year? At $115 a square metre, what was that equating to?
It was about 1,300 square metres, so he might have been paying like $140,000 a year, right?
So $140,000 a year, and you've just offered him $500,000 to leave.
I was like, I'll give you $500,000 to leave. Okay. He's like, yeah, that sounds great.
I'm retiring.
I've just gone through a divorce.
Perfect timing.
Yeah, this is amazing.
Can you do it after divorce? I don't have to split it.
He's like, are you kidding? Are you joking? I'm like, I'm not joking at all. I'll give you $500,000 to leave. He was like, where do I sign? So within a week, we had signed a heads of agreement, okay? I bought that property for $3.1 million. It was valued at $4 million the day he signed that.
$1 million in uplift without
a tenant, because I had unlocked the ability to lease it at a higher rate. But with the tenant in place, I was like, I can't do anything here, right? So then it went from 3.1 to 4 million. So now I knew I had 6 months left.
You haven't put a dollar in at this point.
Not a dollar in, right? Now I've got a contractual right to buy it at 3.1. It's worth 4, as the valuation says. And now I'm like, I've got 6 months before he vacates, I can find a tenant.
To pay market rent.
Put a lease board up, secured a tenant. Property was worth $6 million the moment I signed that lease before I bought it.
So you haven't put a dollar down.
Not a dollar down.
And you've increased valuation from 3 to 6.
Yes.
So you've pulled out, on paper, $3 million without a dollar down.
Yes.
So capital growth does exist in
So
commercial real estate.
so it does exist. But I use that example because you can see on both sides how the fact that because the tenant had a right to occupy that premises, it actually tied it up. It meant that the value couldn't go beyond 3.1.
So that's the myth, that a lease in place is a better asset when in some
Exactly.
cases...
They've got to be paying the right rent. So in order to, I removed that tenant, I had an uplift in value. And then from that point, it was now vacant, but I could lease it at market rate. So 230, 235, 240 a square metre. And I was able to do that. I ended up getting an international tenant to take the lease. It'll be their first site in Australia. Be very excited when that comes out, I think in about a month or two's time. But what we're saying there is vacant building at 4 million, worth 6 million as soon as that lease was signed. Because anyone buying that property now looks at that and says, I'm going to have an annuity of income from that tenant for 10 years. And that's worth
And they're
something.
paying for that income.
That's right.
And I think that's what people get quite confused about commercial property. They don't really understand it. And I get clients coming to me all the time saying, look, I want to buy commercial property. So great, what's your budget? And they're like, I don't want to spend any more than $1 million. And I said, look, okay, what are you buying when you're buying commercial property? And they're like, oh, this commercial building. So look around, just where we are. We're in a retail office area, and they say, oh, look, we could buy the hairdresser, we could buy the coffee shop. These are all tenants that sit in properties that are worth $1 million circa, more or less.
Yeah.
Problem is when you're buying commercial, it's the strength of the tenant as well, right? Because they're not recession proof, they're not COVID proof.
No. And
I think can be the misconception with commercial property. It's not just the building with commercial property. It's not like just a house that, oh, that's nice enough. Someone will live in that house. Doesn't matter the condition, that location. Someone will live in it. Yeah. Commercial is a little bit different.
Yes. No, absolutely. There is an enormous amount of value to that annuity that you get from the tenant. Like it can be fundamentally different as a property that's leased versus vacant, right? So yes, you want to know who your tenant is because they're essentially, and get this, they're your biggest investor.
Explain.
So you buy a building for $1 million, right? You can finance it. You get the bank to come in. Great. Maybe the bank gives you $500,000. How long is that lease in place for? And who's paying the rent? Who's paying the rent? That rent covers the interest to the bank and puts money in your pocket. It covers the outgoings. It covers the water rates, the land tax, the management fees, the council rates, the gardening, the landscaping, the air conditioning that goes bust. Their rent covers all of those expenses. They stop paying rent, it's the whole thing changes, right? So we look at that tenant and we go like, that's our, in our syndicated game, we have investors, but the biggest investor is the tenant. Right, so you want to make sure that when you are buying commercial property, that the underlying rental annuity that you get is from a tenant that's going to support it. And there's ways of structuring that in a clever way. You can get guarantees and bank guarantees and personal guarantees, and you can get rent in advance and things like this to protect the fact that you will continue to receive rent.
And also your due diligence period, when we talk about the difference, a residential due diligence period will be 7 days. Yeah. It can be up to 90, 180 days for commercial, because you're going into these businesses and looking at their longevity, looking at their track record, because you want to know whether it is COVID or if it is a GFC or if for whatever reason the market sentiment changes in a particular state, that they will continue to pay their bills, pay their rent and pay the outgoings.
That's it. And we often say, but commercial property is a strange thing because you need to be property minded because it's the four walls and the land underneath it that you're actually buying, right? And in some cases you might get the right to enjoy rental income, but you also need to be a little bit of an economist in a way because you want to say, is that tenant going to stand the test of time? So, for instance now, in the retail game, I went on a tour in 2017 to America and they were like, look, online retail is going to wipe out a lot of retailers. So when you look at buying a property, Without that knowledge, you go, oh, cool, like it's amazing. I've got, Sephora as a tenant. But if Sephora are going to be, bust next year because of online retail and they haven't been able to keep up, well, it's like, well, Sephora...
Well, they change their tack and say we need to go all online.
Yeah,
because
exactly.
we can't have the overheads of paying all these leases, right? It's cheaper for them to be online rather
Totally.
than... Yeah.
Is there like a price point? I know Lachlan mentioned there he gets loads of people and I speak to loads of people as well that think that they're ready for commercial and that's their next asset type. They think of the cash flow, and we've just discussed it's not necessarily always the cash flow, but from a commercial perspective, is there sort of a minimum price point that you would look at, or is it down to the opportunity, like you said, with some of those examples?
Yes. There's two answers to that question. The first one is like the lowest price point. I mean, the first commercial I bought was $419,000 and I sold it for $510,000 2 years later. Bought it vacant, leased it to a gym, 6-year lease to a gym and sold it, right? Fantastic. So that was a $419,000 price point. So yes, you can enter the market. Was that gym going to pay the rent for the next 20 years? Don't know. So that's why I leased it and sold it.
Yeah,
right?
you were in and out.
I was in and out. It is fair to say that at a higher quantum, you start to afford yourself the privilege of usually better location and better rent, as in better covenant behind the rent, right? So, instead of Jim's fish and chip shop, you start looking at, I can get KFC to pay the rent, right? Or I can get, BHP to pay the rent.
And these are business, and why we like them is because they're not going bust.
They're
right?
not going bust, yeah. Or Centrelink, right?
Yeah. The government backed. A lot would have to go wrong. But I think people don't understand that. Like, well, I like Jim's fish and chips. I eat there every Friday night. Why aren't I backing Jim in?
That's right.
But versus Jim, who, we all of a sudden, and most Australians going through a fitness craze, they don't want fish and chips. He's out of business. You've got no one paying the bills. Versus Centrelink, Australian government, aren't going to run out of money. Therefore, you are always going to get paid. And that's a critical thing when looking at commercial real estate, is you're not just looking at the four walls and the dirt under it. You are looking at who wants to use this land if they currently don't already, because you keep talking about that, the use of it. Who's in there now? Are they going to be in there in 10 and 20 years' time? If not, who am I going to put in there that will? And that's, I think, what people probably don't understand. It's not just a property. You have to be an economist, a little bit of accounting expert too, to understand the books of the business.
Yeah.
And do a lot of DD, right? That's where you spend all your time.
It is. And you say, you look at a lot of frogs and you go, oh, guys, they're not good.
How many deals you say no to per yes?
Oh, geez, like hundreds. Like our job is to say yes to 2 properties a year. I mean, that's essentially what it is, right? And I'm taking investor money.
It's a great job, Cal. You say yes twice a year.
But you touched on something there, and the words you said, like, perfect. It's you want to look at what may or may not happen if that tenant ever left. That is, if you can answer that question,
that's your downside risk.
That's your downside risk, and it's solved. Like commercial property is solved in that one question. Because if there's potential opportunity for growth, or the rent can go up, or you can redevelop, or there's a change of use coming through, or there's another arterial road that's going to link in, right? All those things are going to imbue the site with future value when that tenant leaves. And if that tenant leaves too early, you're like, damn, my rent's got blown up. It's like, okay, well, what's the risk of replacing that tenant? Like, how long is it going to sit vacant? What am I going to have to offer to a new tenant to come in? Is there going to be demand from a new tenant? So you're right in that it's not just the 4 walls and the land. You always need to ask yourself the question is, how are humans going to interact with this property if this tenant goes bust or when it's vacant? That's literally, if you can answer that one question, you're away.
And that probably leads into where a commercial property fits in an individual portfolio, be that all in one transaction or in a syndication model. But there's an argument then by spending more and we're not always, when we're advising clients, spending more is not always better. We've seen some of the best assets at lower price points have higher returns. But in that, when you talk about the covenant, the strength of the tenant, typically by spending more, arguably, in theory, you're getting a better covenant, right? And that's probably a better layer of protection.
Yes, it can be. Absolutely. And look, ultimately, you want to, I think it's slightly different in the commercial game than the residential game, because residential game, you can be an investor, but you could also just be an owner-occupier, right? In the commercial game, it's typically like all investors. I mean, there are a few owner-occupiers around the place, but a lot of the game is investment, in which case it's literally a game of risk versus reward. Those are the things you're playing with. So if you have a higher bracket of potential capital to spend, you can buy a safer asset, is what we're saying. Right? I can go buy a 10-year lease to Dan Murphy's in Midland, who are they're going to pay the rent, right?
They're never going under. There's always an
best trading
appetite.
Dan Murphy's in the country, like fantastic, right? So, but that's going to cost you $19 million to do that. So yes, more money, safer asset, but not necessarily a higher return. Do you see what I mean? So I think, the scale, the quantum of money you have can afford you greater security and probably a better income annuity from a more reputable tenant, but it doesn't necessarily correlate to return.
And that's where I find a lot of clients, and we're always doing strategy portfolio meetings to where commercial may fit. And they may come in, look, I'm ready for commercial, and typically they're not going to be in the equity position that I feel comfortable advising commercial, because they're going to be playing in that retail tenancy space, the coffee shop owner or the hairdressing tenant, where it's all about risk mitigation. Where I see with my client base seems to be a fit for it is typically later in the journey, whereby they're not looking for 100, 200, 300% returns like you can see in that resi space, where it's typically can be more capital growth with less cash flow, but they want to be sort of less exposed to the volatility of residential markets, and that's by spending more. That commercial asset where they're going to get a secure cash flow becomes more probable, but also in their best interest, because we're sort of protecting their downside risk by getting them a return from a cash flow perspective, not necessarily capital growth. Is that sort of where you see it in your client base and their stages of their journey? Or
absolutely. Look, our first 10 or 15 investors were all family friends, and they've all retired on the back of income being produced by the commercial properties we put them into, right? So yes, later in life makes a lot of sense. About 75% of our investors are using a self-managed super fund. So again, there's a correlation there between stage in life and having built up enough equity to invest. But I also think it is good to look at it as more diversified. So do you want all your eggs in the commercial basket? Probably not. So I look at my mother or my family, for example, great little portfolio, but they've got 5 or 6 residentials that if they needed to just get an injection of cash tomorrow, you can sell the property in 30 days, right? Like 30 days time, your money's
in your pocket.
It's in your pocket, right? Or very close to. You want to try and sell it commercial, wait 6 months. And, 60 days can go by, and then the due diligence flops over, and, blah, blah, blah.
And a lot can happen in that time, as you experienced in 2022.
Totally.
And
Yeah, exactly. And then, you probably want a little bit of exposure to, cash and having some money liquid. But I think it plays a part in a portfolio. We love it, but even when I look at what I'm doing with my own money, it's not only in commercial. I have got some residential property. Do you know what I mean? I'm a property guy, but what I'm saying is I think as an allocation of a portfolio makes a lot of sense, because it can be more stable, and the annuity of it is very refreshing to experience. Like rent in your pocket on the 2nd of every month is a gorgeous thing to experience. Once you experience it, you're like, wow, that's refreshing. I like that, right? Whereas, residential, you can tie up a lot of capital and it could sit still for quite a while, and the rent doesn't even cover your interest potentially.
And you're paying all outgoings. And talk us through that. People don't understand. They think commercial property sounds great. So in residential, capital growth, but residential, you're paying everything. You get everything besides essentially the utilities when you're not there, but even then you're paying Western Power, or you're paying. So the outgoings for residential is consuming, and like you said, typically the rental income doesn't cover the costs, and in some circumstances doesn't come anywhere near it. We're talking $30,000, $40,000, $50,000 cash burns per year, where that's not the case in commercial.
No, you're right. Look, there are particular commercial properties that you are paying the outgoings on, but I would say the typical lease structure is one of a net lease. And I cover this in my mastermind as well, but like you can structure a lease such that as an owner, you are literally, you have no costs. You receive a rent and that's it. Even your insurance, like you can insure the property for loss of rent and the tenant will pay your insurance premium. So that, and then you can even go beyond that, and you can structure triple net leases in such that the tenant will actually pay for upgrades to your building. Now, usually that's where you draw the line. Like
there's only so far you go. The tenant goes, Jim's fish and chips going, mate, what's going on here? You've marked in here a 3-year improvement
100%.
for old Jim.
But usually the landlord would pay for like your capital structural items because they're improving a building, right? But anything that's a repairs and maintenance and anything that is there to allow the tenant to occupy that space, they pay for. So like land tax, management fees, council rates, land tax, water rates, repairs and maintenance, landscaping, gardening, gutter cleaning, like they pay for it all, right?
So that monthly, invoice payment that goes out is net, right? It's clean,
Yes.
and you're typically going to get a return that's more than what you're actually paying to hold that property.
That's right.
They're positively geared properties.
That's it. I would suggest that unless you really know what you're doing, you probably shouldn't be buying a property where the return rent-wise is not covering your interest, or at least your holding costs.
But I think a lot of listeners would be in that scenario where, because it's very
Yeah.
difficult in the residential market, unless you're buying high density or you're buying house and land packages in out of fringe areas, to get a rental return, because you've got to understand interest rates now in the 5s, but not, it wasn't too long ago they were in the 6s, and to get a 6% yield, you're going into some pretty dicey assets to get that. But you don't, in commercial, you're buying A-grade quality assets at those returns. So you're not compromising on asset quality. If anything, you're doing the opposite.
Exactly. Yeah.
You mentioned, obviously, you gave you the example of your mum. Maybe commercial isn't the right move for her. She's happy with a residential portfolio, and I think so. It's pretty clear that not commercial isn't for everyone. But when do you think is the right time in someone's journey that they should start thinking about commercial? Let's say a lot of the clients that we speak with, a lot of the clients that probably listen to this podcast have maybe 2, 3, 4 residential properties. They've done well over the last few years, especially in markets like Perth or Queensland recently. When do you think it's the right time for them to start thinking about commercial? Or is it purely going to be down to their circumstances?
Look, yes, their circumstances need to drive some of their outcomes, but like to just correct you there, like my mum's got a very healthy weighting of commercial property, but she's also got some residential property. I think that if you've got 4 residential properties and you've got $100,000 cash in the bank and that's it, if I were looking at that and I didn't know who that person was, I'd be like, you're pretty leveraged into residential property right now, or you're pretty heavily weighted. So maybe a change would be worthwhile. And what we typically see is that, kind of 45 plus people start looking at how do I create a more passive investment that I can still touch and feel and that is land backed, and that can be commercial for them. Otherwise, some people start looking to shares and it's like, yeah, it might be passive, but every night you're up checking the stock market because you kind of, the nerves are very high.
You've just dropped
right?
20%, but no, you made 5%. Oh, I'm up 20%. It's down.
Totally. It's like I don't know. You got to have nerves of
It's
steel
gambling.
to play that
It's
game,
qualified
right?
gambling.
But if you want something land back that creates an annuity that you can, start to plan a little bit more on, like if you're getting $1,000 a month and you're going to get that for the next 10 years, like you can start to make decisions based on that and plan on that. It allows you to like look forward. Whereas, if you just go to residential property and you're hoping you're going to get capital growth, it's a lot harder to kind of put the dart in the dartboard and say we're going to be here in 3 years' time, right? So that's an interesting paradigm. So I think that people, when they start having like families and and they move through that like kid stage and they start to say, well, I want a bit more stability in my life. Commercial can offer that. Interestingly though, the young professionals are in like the best spot to take advantage of commercial, because if you were to look at your network now, like an insurance broker, a financial advisor, a dentist, a doctor, your chiropractor, people that run businesses, and guess what they need? They need a place to run their business. And so it's
and
like
you trust the tenant.
Totally.
You understand the covenant.
Totally.
So collectively,
Yeah.
you can house them
Exactly right.
and get
Exactly
your friends
right.
to pay you. It's a fantastic model.
It is. It's a win-win-win. Like I need, if I'm a dentist or a doctor or whatever it is, and I need space. Well, I need space in order to derive my income. So
And typically business owners don't have the capital to put into real estate because they want to put it in their business,
exactly right. So like there's a little sweet spot there that I'm finding now with my cohort. Like the conversations I'm having around the barbecue are like, wow, like I need space, or hey, like what my brother-in-law's a radiographer, for instance, and he's like, mate, like, geez, these radiologists pay a lot of money in rent. I'm like, well, you could go out on your own, and maybe we could find you a spot.
Yeah,
and
I know a guy that can find you somewhere.
That's it.
Yeah.
So I think there's some really fantastic conversations that can be had as you start to get into the real like strides of your career and just look at the network around you. Do they need space? And that could be, there's a win-win scenario there. If you could find the property, they could be your tenant, and you're securing win-win outcomes for the tenant, obviously, the property, and then yourself.
Winding it back there a second to your first point, because it's really interesting the way you've sort of just brought it right down to the base level, comparing residential and commercial, and it's sort of the penny just dropped. It's funny, people invest in residential real estate, negative cash flow in residential real estate. They could cost you 10, 20, 30,000 a year to hold that residential in the hope to get capital growth. Yeah. Where in commercial, you are buying commercial real estate where it doesn't cost you anything. Often it pays you to hold that.
Yep.
So your downside risk is completely reduced.
Yeah.
Again, in the hope to get capital uplift.
Yes.
If that comes, that's really just a positive, because essentially you're getting paid to hold the property. So if you get capital growth, that's the cherry on top. Versus residential, if you don't get capital growth, you have to sell it, and you're selling for a loss. Exactly. So when it's the right time in a portfolio, when you've probably got enough equity, because that covenant that we spoke about is super important. Because the worst thing you can do, and people probably don't understand, is you go and buy a commercial asset and you pay for that tenant. You go and buy Jim's Fish and Chips because you think he's a top operator and he's never going out of business. But you've paid a premium. You've paid a premium for that building because he's in there, and all of a sudden he packs up. He gets taken over from Sienna's Pizza, and then he's vacated. So that property price is dramatically reduced in value. So that, jokes aside, that is the risk, because once that tenant leaves, the difference with residential is people need somewhere to live. So your vacancy period is typically limited to, at the moment, a couple of hours. So in a balanced market, it might be a couple of weeks to a month. Where in commercial, there can be extended vacancy periods, right? If if you look at office in some cities, it's not as bad now as what it probably was 18 months ago. But there is vacant commercial buildings everywhere at any given time. Am I right?
Absolutely, 100%.
Because you're so big on cycles, and I love that. And on this show, we talk about cycles all the time. The commercial cycle, you time the peak of the commercial market, you exited it, at the best time. We spoke about this on the last episode. Where are we at with the commercial cycle? Where's your view on the global market and how that impacts commercial property?
That is a gorgeous question. The thing I'm most worried about in commercial property right now is non-banks. So, Australia, we're very lucky to have an incredibly regulated banking fraternity, right? You can gear to so much for individuals. There's APRA. There's a really regulated system that structures how you can go about borrowing money for residential property, or even borrowing money for your business, or borrowing money for your manufacturing plant, right? Commercial property, the same regulations in place, but not from APRA so much. As in, they're not as worried about the individual now, because usually it's investment funds coming in and out. And what we've seen in Australia in the last kind of 3 or 4 years is like a 40% increase in non-bank finance.
So non-regulated finance.
Non-regulated finance. And that is fantastic sometimes when you want to leverage really high. But what comes with really high leverage? Really high risk. And so what I suppose what I'm saying is that a market can have all the fundamentals that you need to see it grow into perpetuity. But if behind that growth, you've got debt levels that are increasing far faster than the rise in value, what you're essentially saying is the floor, or the tide, as Warren Buffett would say, the tide is running out as you're holding. So that's what I'm worried about. In commercial property, you can generate a return greater than your interest. Fantastic. What's your debt level? Is it 50%? Is it 60%? Is it 70%? Some cases, I've seen lenders now lending 100%. 110% for commercial property. I've done it, right? So if you know what you're doing, I think you can really get in and get out. But as the unregulated finance comes in more and more and more, what it allows is more speculation. It allows you to speculate. And that speculation can, I think, cause a tipping point. So in commercial, I think, timing our entry and timing our exit has always been important for us, but we want to come back to the commercial property that's going to stand the test of time in good markets and bad markets. And that means you're backing the relevance of the dirt and the four walls, and then you're trying to back the relevance of that tenant. So, and we're not the only people doing that. I think there's a whole weight of capital moving towards safer commercial assets. That's why McDonald's and KFCs and drive-thrus
They're
are
becoming really popular
transacting at like ridiculous amounts of money.
because
people
it's
go,
safe.
That's a corner site on an arterial road with 50,000 cars passing per day, so there's always going to be a relevance to it. And, oh, by the way, you know, the best covenant in the world is pay my rent. Happy days, right? Yeah.
So if we're going to answer where the commercial market is in the cycle, listeners are going to have to wait till the next episode because we're running out of time. But thanks, Cal Doggett. Love
Thank
the
you.
chat.
Cheers, Cal.
Appreciate it.